Hi everyone and welcome to this live interview with none other than Zinzino. Don't forget that since this is a live interview that you viewers also had the opportunity to ask questions, which you do in the live chat during this broadcast. I'll be looking at the chat during this interview. So with us here today in the digital studio is none other than Zinzino's CEO, Dag Bergheim Pettersen. Welcome back.
Thank you. Good to see you.
Good to see you too. I thought we could dig in straight into the report. You reported a total revenue of 395 million, which is an increase by 18% from last year's 334.4. Could you summarize the quarter for us?
Yeah, I am pleased with the growth and pleased with the results out of the scale that we have been announcing a couple of times before, that we have a scale beneficial or benefits from growing. So you can see that on the gross margins. You can look at the bottom line, that everything goes pretty well when we are growing, and we have a growth wave of, as you said, 18%, which is pretty good. And it seems to be holding in. So I'm very happy with things, how it goes.
Your gross margins have increased from last year. I believe last year was 29.1 and this year it was 32 something. You might correct me on that figure. But let's talk a little bit about your markets. Africa grew the largest, as well as Central Europe also saw growth. What are the important ingredients here? What is driving it? What is driving it?
Well, we have an underlying customer growth, and most of our customers are buying maybe more than one product as well. And then we've done some, we bought a company last year in the Central Europe, which is the market, which is the driving force now, I would say. Germany, Switzerland, and Austria is really doing good. Netherlands as well. So we are approximately almost like 70-80% above last year in these markets. And the driving force is new customers and customers that spend more money on the health products that we have.
The acquisition here, I'm curious if we can expect a similar growth rate in the future. Will comparing the following quarters that comes here in 2023, will that show slower growth numbers now that acquisition is made?
Yeah, well, last year was actually it was only 5% growth, and we weren't like super happy with that. I think that is the lowest year as far as the 17 years of Zinzino's history. But one of the things that we did, what was good, that we went inside and looked at ourselves and were looking what are the things that we need to improve and change. So we've done a lot of adjustments last year. Cost reductions, we were talking about less is more, so we removed a couple of things that we did. We acquired a company, and we were kind of now investing for growth, and we had enough time to deal with different things. So my humble kind of projections is that we will grow more than 10% over the next 3 years. But we are hoping for more, and we are aiming for more as well. But we shouldn't be too proud of ourselves. So let's see how things is turning out. But the growth target is between 1.5 and 1.6 billion Swedish kroner, and that's something that we would like to reach.
We'll talk a little bit more about your growth potential and goals later, but I'm still curious about the European markets. The success factors that you have mentioned now, could they be transferred into other markets, and if so, how?
Yeah, we are actually doing that. We are using a kind of a blueprint in everything that we do. We were established in Scandinavia, and then for the first 3-4 years, we were only kind of operating in Scandinavia and kind of fine-tuning everything that we did. We are a direct sales company, and we've done lots of adjustments. We have one of our core values is continuously improvement. Then we expanding to the Nordics, and then expanding to the Baltics. So in everything that we do, we use the same method everywhere. But what we need to do in Asia is to adjust a little bit on how we are approaching and maybe how we're marketing things. And then, so Asia is a little bit, I would say, we are going slow before we go fast. So we tested out, we bought a company 3 years ago, and then we are still learning that market. So maybe we need to do some adjustments, but we would like to use the core of everything that we have developed here in Scandinavia. So that's a long answer, and to be saying that, yes, we can learn and adapt to all the different markets across the world.
Unfortunately, I will have to ask the answer to be longer. Could you elaborate on why the Asian markets are different?
I think there is a little bit like how the buying pattern. So here in Scandinavia, we are used to subscriptions. We have subscriptions on the mobile phone, even on the training centers that we are working on or working out on. So we are used to that kind of model, and we have a certain way of buying stuff. But in Asia, there is a little bit of a different way of thinking. So they like to buy maybe bigger volumes and instead of every month like we do here.
The growth for your Eastern European markets grew by 11%. What is the current outlook there? What do you expect for 2023?
I am expecting us to just growing like we've done. And that's one of the parts of the world that we have done pretty good the last 3-4 years. And we have fantastic distributors who is working like really good, and they know the way of working with us. So I expect an outcome on the same level or maybe better even.
And Eastern Europe is one of your larger markets together with Central Europe and the Nordics. You mentioned that you're aiming for an average growth of 10% per year, but I'm curious, by 2025, will the market distribution still look like this?
I guess so. I think that Europe will be the main growth engine in our strategic plans. But of course, I believe and expect that Asia will take a little bit stronger part in the whole distribution kind of network. We are soon opening Mexico, and we are working on a plan for Latin America. So I expect also North America to grow more than maybe what they've done the last 5 years. We have an interesting setup in Turkey, so we have more revenue coming from the Turkish market as well, and then so slowly and softly expanding to Africa. But the short answer is yes, Europe will be our main kind of growth machine, to put it like that. But I believe that the other markets will expand and do better over the next 5 years. It takes a little bit time to settle in a market. We've seen that many years. So that's typically normal.
It'll be exciting to follow how your markets develop. I'm also curious about churn, however, and the question is the subscription cancellation rate coming up in the wake when households' purchasing powers are decreasing?
Yeah, that's something that we are afraid of. So of course we are working to glue and to stick and to make sure that people are putting their health first. Our products are still kind of affordable for like a monthly spending. So we believe that we will keep a lot of customers, but we also aim to get new ones. So I'm hoping not to see a drop, and we are working strongly to keep the customers happy in the model that we are using. I think the awareness of health is increasing, and we've been talking about this earlier, but the pandemic learned us that we need to take care of our own health. So the awareness is helping us. So, and also that what we are selling is more and more trendy. Test-based nutrition is extremely important for a lot of people. So I believe that the trend and the awareness will help us keep the customers longer than we ever seen before.
Could you tell us more about the similarities you might see from the market conditions during COVID and the market conditions we currently have for your products?
I think I'm not sure if there's so many differences today than during COVID. But of course, people are spending more on vacations and traveling and all that. And we see the power prices has gone up. We have had the big crisis and the war in Ukraine. Um, Less products available is also a thing that came out of the pandemic and was added up with the Ukrainian war. So there is a struggle to make sure that you have enough production ingredients and excipients. So that's a thing. Uh, I think mainly we have been structured ourselves in a way that we have the capacity to handle these kind of crisis. So we are only focused on ourselves. But of course, we were almost opening Russia and we had everything set in place, but we needed to withdraw ourselves. So that, of course, impacted our results from last year. But I won't say there is a lot of changes, but I think the health awareness among people in general and the willingness to spend money on making sure that you take care of yourself is high and higher than it was before the pandemic.
We'll move on now and to what you said in the beginning of this interview about your gross margins. They are increasing, started to increase in Q4 and also increasing now here in Q1. Could you tell us a little bit about what it was that improved the gross margins? What sort of costs have you reduced?
I think mainly, and this is going to be a long question, so maybe I should turn it into points. So point number one, we reduced some costs last year that is impacting us today. And we simplified some of the things that we are now doing that we actually took a decision on during last Q3 or something like that. So that's one thing that impacts. But I would say one of the main thing for us is the scale of the business that we are dealing with. So if you look at the gross margin, it's impacted by if you keep a growth and you don't overspend on your fixed cost, then the gross margin will grow. That's quite easy to understand, that math. And that's what happened in Q1, and it will happen moving on over the next years as well. The magic here is not to overspend or to increase prices or to make sure that you don't overspend on different costs or you have bad agreements. But the hardest thing in every company does is to keep a growth over 10 to 15 to 20%. So that's the magic. Growth, scale, then a higher bottom line.
You increased prices from last year and of course the higher the margins the better. How do you view the prospect of eventually raising prices again?
Yeah, so you need to be cautious when you deal with customers and their spending and their pocket and money and all that. So we are really careful when it comes to this. But we increased the prices from 1st of May this year. And mainly because the raw material have increased more than what we increased the prices. Inflation is also really kind of ugly at the moment, I would say, all across the world. Hopefully things will be coming down. And then also to get access to different things like products, olive oil, and different things that we are selling is really harder. So we needed to increase the prices to keep up with things, but we are really careful when we do that because that's a major thing for the household. But then again, I believe and I hope that that customers evaluate our products as something that they could really benefit from their health. So hopefully that they will have the money to pay for the subscriptions and all that. So I believe strongly that we will keep customers.
Your EBITDA margin, you have your target is that it will be above 9% by 2025, and this is given the average growth rate of 10%. But how will you maintain this margin that you currently have now?
Well, I think that the target that we have is good, but we are above that margin in this quarter, and little bit because we've done some changes. We've reduced some costs, um, and also it is a little bit based on where we are buying and where we are selling products. But there is a possibility to even earn more money in Zinzino than what the margins you see that. But we also want to invest in growth because, as I explained, the scale and you keep costs, then the margins will grow. So we have patience to to um, to grow the margins. So what we need to do is to spend and invest. We're investing in tech, we're investing in new markets, we're investing in product development and studies, and we will continue to do that. So what the board and the main owners and the management are in agreement of is that 9% is a perfect kind of balance of how you do dealing with things. And if we are growing faster than what we are expecting, then we will earn more money. So that's the analytical answer to your question.
Indeed, but the EBITDA margins for this quarter was 9.5%, and last quarter in Q4 it was 11.3%. With this in consideration, do you have room for the future to sort of scale off that margin to, as you say, grow?
Yeah, we do that. We are in our own hands and destiny to do all the good things, but we need to keep on doing the everyday work and make sure that we don't do lots of big mistakes and then grow the markets, add new products when needed, acquire companies, which we haven't talked too much about this time, and then keeping our customer base happy and increase that. So I believe strongly in the future.
Very well, then Dag Bergheim Pettersen, thank you very much for answering my questions today.
Thank you for having me.